This is the episode 40, the June 2021 monthly market update with the real estate brothers, me and Dean.
All right. Can't believe it's been 40 episodes, 40 weeks in a row straight. I hope I didn't jinx it, but I think we haven't skipped any weeks so far, huh?
Yeah, let's hit the intro.
We just two local guys with so much to say this today.
And welcome everybody. Tell everybody what you're drinking this Thursdays.
Hey everyone, I'm Dean Ueda. I'm a former CPA, now real estate investor and realtor. And I have, don't laugh, Lane, I'm drinking some Michelob Ultra today.
Low carb, right?
Low carb, yeah. Someone brought it over the other day and said, I might as well finish this up. How about you? What are you drinking today?
I'm drinking the Pinot Grigio from Costco. It's about $5.98.
Oh, nice.
It tastes like $100. Actually, there's a new tip for wine drinkers out there, Claudine wines. So you can buy like $120, $150 bottles of wine for $40, $50. Because what they do is they make deals with the winery and they white label it under them. So you can get like really expensive bottles for a third of the price.
Oh, nice. Oh, interesting. Okay. And that's white and red?
Mostly reds, yeah,
Okay.
like Claudine wines. So
Yeah.
they'll go to, I think it's Coonsville, or I think it's like the popular place, but that's like a stag's leap.
Oh, okay. Yeah, Stags Leap. I like that one. Okay. Well, if you guys are tuning in, you must be seeing us on multiple channels. It would be love it if you guys could check out my YouTube channel. I started it maybe like a year ago in the heart of COVID, but every week I stream some nuggets of value adds, like about 5 minutes each. Tune in, subscribe. I would love if you guys interact with me. So let's jump into the real estate market statistics. So as today is only the third day past May, we haven't had any official information from the Honolulu Board of Realtors yet. It'll come out this coming Sunday or Monday. I think Sunday actually. So just the Nostradamus prediction for May is we're going to have another record-breaking month for May 2021 in terms of median single-family homes. We're going to be around 978,000, which is breaking our previous record of March 2021 of $950,000. So we're edging up to that $1 million median price mark in Honolulu, Lane. Kind of crazy. Condos are actually creeping up too. We're going to be at just under 458,000 for condo and townhouse median prices, which is up from 399,000 in same time last year. So that one is also creeping up. I'm not too sure. It's getting up there in terms of close to the record median price for a condo and townhouses. I think is like 458. So it'll be pretty close. But I think the whole story, as it's been in the last, I don't know how long, is going to be the single family home. And as I like to do, I like to talk about trends at a high level. So again, at the beginning, I slap in these charts that we can just look at how the lines are going. So new listing trends for the last 3 years. It's nothing crazy. You have the up and down, but we have new listings coming on board. If you draw a line, it's slightly dropping, but for the most part, I think it's stable. A little bit of a downward trend, I would say. But what we'll see when you look at homes for sale active, here's where you see in the last year and a half where it's definitely going down. It's making it really hard for our buyers. It's really a strong seller's market. So again, next slide, we're looking at months supply of inventory, meaning if we were to stop having any new inventory pop up today, how many months would it last? So for the end of May, we have single family, we have 1 month of inventory. And for condos, we have 2 months of inventory. And you can see the trend is consistently going down. So again, making it tougher for our buyers and making our sellers have all the leverage in the world. Yeah. So that's something. And again, this is really high level. Everything is local. So in some areas, it's going to be a different story, but that's more of the high level. I wanted to transition over to military PCS season right now. So now we're hitting the heart of the summer months, right? Can you believe, Lane? We're almost halfway through the year. Oh my gosh, it's like it's felt like just last episode we're talking about the new year and vision boards and all planning and
For 2020, right?
yeah. Oh yeah, that's right. But anyway, I digress. Last month, I was helping a lot of my local clients and friends find realtors in the mainland as they were getting their PCS orders. This month, I'm getting in a lot of calls from military buyers overseas that are coming here. So just an anecdotal analysis, I'm thinking that the increased inventory from the military sellers have occurred in the past months because majority of them planned ahead and started listing their properties early in an attempt to sell. And now we're having the buyers are coming in now, and then they're looking. Again, this is real anecdotal because you have ones that may be selling after they move, and you may have buyers who are looking before they came. But I think in general, I think what this means to us here is that we're going to have more buyers from this PCSing than inventory popping up in general. So just
more guys at the party, right? More guys, right?
Yeah, going to the club. And that's why sellers come in free and the guys have to pay a high cover.
But perhaps in the future, the tides will turn. We'll see what happens when all that forbearance is on,
yeah,
right?
that's true. And then that kind of segues into the next slide we're talking about, Lane, in terms of tourism, right? So I don't know about you, but I have friends, family, and clients who are getting called back, the ones that were the frontline workers in tourism over in like Waikiki. So I have a lot of friends who've been getting the call over the past 3-day weekend, actually, because now that they're ramping up in terms of flights coming in. So looking at the statistics now for June, this is from DBED, and so our flights coming in domestically are catching up to what they were almost like pre-COVID in terms of domestic side. But what we're lacking is on the international flights coming in. Of course, Japan, not letting even us go there. But so what the challenge is there is that it's the international travelers and tourists that come here that actually stay longer and actually spend more money. So even though we're up to almost 80% of how we were pre-COVID in terms of flights coming in, that additional 20% that difference that we're lacking is from the international flights, and those are the ones that brought us the overall margins or larger revenues in general in terms of tourism.
Are you saying the people that are coming over are just like the bargain hunters?
That's true too, because of the flights, right? Because they're offering cheaper flights and stuff too. But I think more so just in general is that the international travelers stay longer and spend more. There might be truth to that too, like you're saying, Lane, because even, if I had my way and I'd be traveling and trying to be traveling at a deep discount, right? Taking advantage of that. So I'm sure there's a lot of that too. And the point to your comment about what's going to happen further down the line if we're going to see more foreclosures or distressed property sales because of all of these forbearance and things that the government is providing to us. And so who knows what's going to happen down the future, right? And when it does, I think it'll probably be more the mainland than here. But yeah, it always, the reminder that some people haven't been working for over a year and others haven't been paying their mortgage for the same amount of time, and that's just a chunk of money that tacks on to the end. And if that benefit was ever removed, then that's going to be a big game changer, I think. So
people don't know what forbearance is. So basically they let people not pay their mortgages for a while because of the pandemic, but it didn't mean that their payments didn't start to occurring. So right now, if you put your loans on kind of forbearance, if you had a Freddie Fannie loan, you're going to let the banks sit this. You may be looking at $10,000-$20,000 of a bill that you got to pony up now. And knowing most people who go into forbearance, they don't have 20 grand lying around, especially if they were out of work for 6 to 12 months. So that kind of thing is working its way through the system. So people don't know how this is going to react. I had George Newberry on my podcast who buys distressed properties, and he's licking his chops right now that a lot of blood is going to be coming through the system. Do you know when the forbearance is going to go away? I don't really keep up too much.
It's been going on for so long. I'm not sure.
You just figure you just never have to pay your bills, yeah.
You see, what adds to the challenge of this is the fact that you also are challenged in terms of if you're trying to refinance or obtain new debt, yeah. So that's, I think, gonna add. How you said George is smelling the blood in the water. I'm thinking when you do that, you're biding your time, but it's also reducing your other options, yeah. So that's the challenge, I think. And I know George, I read his book, and I know he's been through a few cycles himself. So I'm sure he's ready to jump all over the opportunity, right? So have your dry powder ready. But anyway, this slide was just playing on the previous slide where we're talking about on the left side, it's 100% was at that blue line was what we were at pre-COVID. And now if you look at this yellow line, how the passengers are coming up, we're at that 80% mark. Yeah. Again, this is domestic flights which are the ones bumping up, and we need a good mix in terms of international as well as domestic coming in. And yeah, I've talked to a few of the workers that have gone back, and then asked them also, how are things in Waikiki? And he's like, yeah, things look like they're picking up. And so I asked him, how's work in terms of just the atmosphere and things like that? And he's like, so the responses that I've got is things haven't changed, but they're working with smaller crews because they haven't bumped up to fully staffed. So they're working with, not to say skeleton crews, but like smaller crews to handle the crowds that are coming in, as well as, needless to say, the new COVID procedures that they have to follow and stuff like that. But the ones going back seem to be happy to be doing so that's a good sign. So one thing I wanted to end with, my son started playing a lot of tennis recently, so I've been trying to pay attention to like even the pros. I think the French Open is going on right now, and the biggest buzz that's hitting the media by storm, Naomi Osaka, after her first round, she won her first round, but she actually has pulled out of the French Open because she was getting pressure, I think, from the media to do the press conferences that are mandatory and it's in their contracts and stuff. But prior to going into the French Open, she had said she didn't want to talk to the press, and they tried to make her, and they fined her when she didn't. So then she said, okay, she's going to pull out. And afterwards she mentioned it was because she's had bouts of depression in the past, amongst other things. It's actually a really big thing in the tennis community now. And I was actually, just before jumping on our podcast, listening to some more comments. And so one of the big things is mental health, and us realizing that. I believe we missed it by 3 days, but I believe May was a mental health awareness month. 3 days off, something for everyone to consider. I put some statistics on this slide where it says 1 in 5 US adults experience mental illness each year. It's interesting too. I don't know about you, Lane, but I've been talking to friends, reaching out, and more people I talk to, I am finding out that some of my friends and clients talk about having this kind of situation where, in the past or currently, where they have depression or bouts of it. So I don't know.
Most people have some kind of depression. Like, it's staggering how many people take antidepressants.
Yeah,
you're almost weird if you don't.
Yeah, or don't go to a psychiatrist or something like that. But yeah, for me, it's like, wow, it's the point I guess I wanted to make is, especially now with, I guess we're coming out of COVID, but we still don't know what the new normal is going to be. But we talked about this in previous episodes too, right? When we say reach out to your loved ones and talk story to them, because a lot of times a random text, a random phone call, a random Zoom call can mean the world to some people. And just, I don't know about you, but I've gotten calls from friends and that I haven't heard from a long time, and it just is, it's a little bit of a pick me up, and it just makes me feel a little bit better. I'm assuming if someone who is really down and out gets a random call, you could make a difference. Keep that in mind. Something not really related to the mental health, but related to this whole Naomi Osaka incident, was they're talking about how the media plays into these professional athletes. And I know, Lane, you pay attention to, I think, NBA stuff, but they're saying about how the whole thing with the press and needing to talk to the press post-game or post-tournament press conferences are antiquated from the standpoint of the purpose, because a lot of the professional athletes can reach out directly to their followers directly with social media or whatnot. So not to say that you don't need the media. Back in the day, the media would react to like a MLB player who didn't want to talk to them and say, hey man, I'm the one that's making you and getting you paid your money. That may not be the case in this day and age. So it started spurring up all these conversations on social media in terms of the media and professional sports and the relationship. So I thought that was interesting too.
Here, so they don't find me, right? They need to bring that back.
Oh yeah, I remember. Who is that? Yeah, I remember that one for football.
I think that was Marshawn Lynch that said that stuff.
Yeah, I remember that. With his headphones on and he's just sitting there, right?
Yeah.
Not even paying attention.
Yeah, Kevin Love, Kyrie Irving, Candace Parker, they all went a little bit there for a little bit. But it's normal. A lot of people are like that. No shame. There's a lot of apps. I know a lot of people say they like the apps. You don't have to drive anywhere and you just talk to a licensed therapist. I forget what the app. There's a lot of them out there that do it, but better than nothing. Giving health advice, that's for sure. But people would say that's pretty cool. But yeah, let's get into see what's happening on the national level here. If you guys like more of this passive investing talk, check out my podcast, SimplePassiveCashflow.com. And here we go. Here's high-level teaching points here. Don't kill the chicken, just eat the eggs, right? Buy assets that produce income and eat the income. Or if you don't need to eat the income, put it to more investments. That's a secret. Finances, we're done. That easy, everybody would be doing. But another part of this is investing tax-efficient way, right? The little deer there's licking the back of the neck of the other deer. They love it when you just flip houses and trade, buy and sell things because the IRS is getting a piece of the action. That's why we like real estate, because we can shelter a lot of the gains through losses, paper losses from the asset. Oh, this is a joke here. The more random people jogging around for no reason signifies that it's a Class A property. Yeah, let's get into the monthly report here. So I think everybody's been seeing this in the news, but prices of lumber and other commodities are skyrocketing through the roof, more than 3 times where it was baseline prior to 2020. And this is inflation, guys. This is exactly what I've been telling you guys since the start of the 40 episodes. What is that, 3 years ago? 3 years? Yeah, 3 years ago, we started this thing. Buy assets, because if you keep your money locked up in your home as equity or checking account or not doing anything, you're going to lose, because right now there's a great shift in wealth. The people that have money are putting their money in things that will go up with the pace of inflation. The people who don't are going to be losers and getting their money devalued over time. So be akamai. Don't sit on your wealth. So we had a correction in the crypto arena recently. I don't know. I'm going to play around a little bit with this stuff, maybe 1 to 5% of my net worth. In my own humble opinion, I feel like if your net worth is lower, you should do less. Go out and build a portfolio of prudent cash flow and get to a point where you can do some of these more asymmetric plays. But I don't know, Dean, you play around with any of this Bitcoin stuff or?
I actually am. So to your point exactly, and it's just the best way is to just jump in and try, but not with a whole bunch.
Yeah. Are you doing? So there's 3 types of ways you can play this. There's the stable coins where you maybe get 5 to 10% returns, where you're basically lending your money out to other people trading this stuff. Number 2 is you're buying Bitcoin or Ethereum, kind of the blue chip cryptos. Or are you buying more of the altcoins, the asymmetric risk, high reward type of stuff? What are you doing?
I just started off by buying some of the, like you said, the blue chip stuff. So some Bitcoin and some Ethereum. And then I bought some of this other crypto that I was going to do some staking. So I was going to try just dabble in that where I would get, I believe it's Ethereum and that other crypto coin and have it staked on a platform, and then they would be paying me. So that it's like putting it in the virtual bank where they would be paying me interest, and then they had use of that crypto, like keeping it in a bank, right? But because
on a BlockFi.com or like a DeFi platform?
It was a DeFi platform, yeah.
Wow. You're really going all in, man.
I haven't done it yet, but I was something that I was just gonna try on. But yeah. BlockFi, they pay a little bit, not much. So I was just gonna try this, and like how you're saying, Lane, or it's just I'm not a specialist, but I just wanted to dabble in it just to be able to expose myself to it. So talking to friends who are getting more heavy into it and taking the time to research, and so that's what I was going to try to do, just so that we can have these conversations with people. Because if not doing anything, I would have, it's really hard to have discussions with people who are doing it if you're just reading about it.
Yeah. So why are you going to do the DeFi instead of the BlockFi?
So again, the DeFi, that play is just to see how that works. It's really with not much money, because my main strategy was just how you mentioned, one of the options where I was going to just have some blue chip crypto and keep it in BlockFi. And again, so in this strategy, I'm using my deferred, I guess my solo 401k money. I'm going to use my solo 401k. And part of the reason is, in theory, less tracking for tax purposes, because my CPA doesn't really want to deal with it. So
is your deferred, your QRP plan, is it like checkbook control?
So it's initially it's the dollars, I rolled it over from my old 401k plans, and then I put it into a solo 401k plan in a bank. Yeah. So just a traditional bank has.
Do you have to go to your custodian to write an order, or do you have checkbook control?
Oh, sorry, my apologies. I do have checkbook control, so I have the checkbook and I have full authority in the solo 401k scenario as a trustee, because I think technically it's a trust. So I have the authority to wire or cut checks to then send it over to the exchange, and then at the point it's at the exchange, then I can trade it at the exchange.
If I had a retirement account, I would probably be investing through syndication.
So
that's how I would play it. I wouldn't have to screw around with it.
Yeah. And that's what I plan to do too. And yeah, again, like how you mentioned, Lane, I'm using a really small portion for the crypto, and then the remainder sitting in my solo 401k, I want to put that into syndications and not even.
Oh, no, the Bitcoin, like your allocation of Bitcoin or crypto, syndications for that stuff.
Oh, wow. Okay.
That's what I would do. I'm not a big fan of like ETF fees and stuff like that. For something that's, instead of walking around with your USB wallet, I think I would pay for that type of stuff. That's just an idea, especially if it was like retirement fund, something to think about.
That's a good point. Yeah, maybe I'll look into that. Thanks for that, Lane.
We'll see. But all right, moving on. So homeowners' most common regrets about purchasing their current home is they should be regretting it because they're buying into one of the hottest sellers market of all time at the moment. I don't know why you want to be buying into a seller's market, but here are the regrets. The biggest ones is maintenance and other costs are too high, bought a too small of a house, bad location, didn't get the best mortgage rate, bought too big of a house, mortgage payment too high, overpaid too much, where they realized it wasn't a good investment. So this graph shows the difference between all ages versus millennials, the breakdown of regrets.
So statistically, they're like double of everybody else, pretty much, in terms of having regrets for buying.
Yeah.
Wow.
Yeah. Maybe like people getting married in their 20s. I don't know. Maybe that's a bad joke. All right, so net population growth by county. So I think we see a lot of different charts and graphs out there that illustrates per state, which I think is useless and bad data. This one is broken down per county, better differentiator of where the population is going up, which to me is the biggest indicator of where you should invest, other than what rent increases per year. Where this past month I've invested in Texas, Alabama, and I did Vegas. So next time we meet up in Vegas, it's via business expense.
Oh, cool. Yeah, sounds good. I'm doing Vegas too, I believe. So
yeah, I sure hope it's a good investment. All right, so the Harvard came up with the study kind of showing the differences between millennials and other generations. Some of the big differences are marital status. So millennials are less likely to get married than earlier generations. Home ownership, millennials have a less likelihood to become homeowners than previous generations at the same age. Millennial home ownership is rapidly catching up in recent years, however. Average personal income, despite the popular media portrayal of struggling millennials, their average personal income has surpassed that of earlier generations as they age into. They got the money, is what they're saying on average. And then multifamily residents share the millennial generation living in multifamily housing far more frequently than baby boomers did. But they're following their parents' migration to single family homes. And some people say that's like another reason why the current rise in prices, because you got baby boomers downsizing the starter home, millennials competing for those starter homes, pushing prices up. I don't really buy it. To me, it's just simple supply and demand. It's super low supply right now, as evidence. Tax changes potentially coming up. I would be pretty confident that these are going to be pushed through. With Biden's getting rid of the 1031 exchange for capital gains greater than $500,000. So if you're trading up less than $500,000, you don't really have to worry. As of yet, we'll see if this truly gets put into play here. But I think this is a good idea. I'm not a big fan of the 1031 exchange, and I think most sophisticated investors don't really use them because they don't clump their money all into one investment. That's not diversification. I don't think you should have any more than 10% of your net worth into any one asset. But I think with this hits is the lazy that gets pushed around, that they have these huge gains. I think that is who should be taxed, humble, right? Not the smart people money, not the people hustling, trying to improve themselves, learn, get smart, surround themselves with the right people, but the people that don't care, they don't know.
The old
money that's the 90% of money that gets lost in 2 or 3 generations. So carried interest, for those of you guys don't know, is like how mutual fund managers get paid. There's this thing called the 2 and 20 rule. So they get 2% asset management fee as sort of their load fee, and then they get a certain percentage of the upside, typically on 20%. So that's called carried interest. So currently, how things are structured right now, they get taxed at a lower rate for that carried interest, which is unfair in my opinion. It's income to them, but they somehow finagled or lobbied their way to call this carried interest to get taxed at a lower rate. And right now, that's on the chopping block right now to get put right back at the regular 37% tax bracket for those dollars. But those people out there who are like, yeah, screw the one, that's probably a good one, for people who think like that. I don't know. Me personally, I don't really think like that, but I think that's fair. To me, it's income. All income should be the same, unless it's from real estate.
You're the modern day Robin Hood.
So new construction took a nosedive in 2020. So it was steadily increasing for quite a while. And then it took a nosedive for obvious reasons, the pandemic. So we'll show a little slide later on the housing shortage. Sam Zell is another old guy on the same level of Warren Buffett. Not too many people know about Sam Zell, but he's another czar of finance and investing. But he's here touting on gold as inflation is here taking over.
That's a pretty interesting one, Lane. I know maybe prior to this, I don't know if you want to call it the crash, but when the crypto kind of took a nosedive a few weeks ago, I was thinking a lot of people in lieu of gold were throwing stuff in the blue chip cryptos as a means to hedge from inflation or hyperinflation, as Sam is. So I was wondering, I wonder if I should buy some gold for fun too.
Yeah, gold and crypto is the same thing, right? It's a sort of a store of wealth. I disagree with Sam Zell on this. I think he's stuck in his ways, right? Gold's probably going to be the top king in his lifetime for sure. But right now, what is gold market cap? 10 trillion. Crypto is $1 trillion, the fastest thing that ever got to $1 trillion. I don't know. What do you think in the next 30, 40 years? You think crypto is going to be more than gold?
That's a good point. Yeah, like you said, I'm getting out of that mindset where it's like, I think I mentioned before I got into real estate, I was only thinking stock market, 401k. And after I started to do real estate, it opened my eyes. And so what made me think of crypto was, if crypto is like how I viewed real estate, I need to really take a look at it seriously as a viable means of legacy wealth, or at least to diversify my portfolio, because the haters of crypto are, like you said, Lane, a lot of them are the old mindset. And I don't know, so much has changed in terms of the economies and technology to layer on top of everything that it's just such a new ballgame. Yeah, it behooved myself and my family not to try something.
It's an emerging asset, that's for sure. I don't know if you don't listen to my podcast, I'm so tired of me.
No, I do sometimes.
Check out the last 2 podcasts on crypto. Like one of the big aha moments there was like, if you look at which are the countries that are adopting crypto, it's all like the countries that have just gone the crack, like Nigeria, all the African countries and places, because they've lost trust in their country, their federal reserves, and they've ditched that to a more stable thing, which is cryptocurrency that is decentralized. I don't know, part of me feels like America is always going to be the strongest thing out there and controls the world policy. So it's US dollars, all right, but the whole rest of the world is going to this stuff. And it's a very libertarian thing. It takes power out of the countries and into the people, and where the currency can't get.
That's almost like egocentric, and that could be our downfall too, right? From that.
Yeah. So again, personally, I'm not going to do more than 5% of my net worth at this point. Yeah.
But at least enough to understand it a little bit, so in the case that we need to move in that direction or pivot somehow, then we can.
Yeah, and it's definitely not, on the one hand, it's good that the big banks have started to invest in it, because they're not dumb money. But then again, if Elon Musk can get on Twitter and troll everybody to pump up his Dogecoin, then that's showing that how immature the markets are. So there's still room to go as an immature market. But I think there's a time to get in, because I don't think it's going to fall down, but it's still, the time is now to get in.
Yeah, I agreed. I don't think it's too late. Of course, the people who got in years ago are all sitting happy, but I don't think it's too late still either.
Yeah, I have some guys in my family office group, and it's funny. They weren't the first who did this stuff for sure. They got in the past like couple years, but their positions grew to be a pretty large sum. I want to say 20 to 30% of their net worth. But when I really quiz them on it, I come to find that they really only put in 5 to 10%, and the damn thing grew to be 30% of their net worth. But now they're playing with house money, so it's kind of like hockey, right?
Yep.
So it's hard for you to come in now and put in even 5% of your net worth into this stuff and see it go up. But if you don't put in, you never get in. Same thing like buying a rental property. If you never get in, you're always going to be the fool tire kicking from the outside.
Can't time that appreciation uptick, right? So, like you said,
now's the time. If anything, if you're sitting on your cash, you're going to be a loser. Inflation is engulfing, taking your money away. You're still going to leave you at the same dollars, and could be worth jack. That's the thing.
Yep.
So top 5 Sunbelt markets for industrial construction: Dallas, Houston, Phoenix, Inland Empire, Memphis. In that order. Are millennials living cities? Yes, but young adults are not. So if you guys watch this on the YouTube channel, we also have this on the podcast too. For those of you guys listening on the podcast, iTunes or Google Play, Stitcher, you guys don't see these cool charts, but it shows how people are moving outside of the top 50 MSAs, which are like the big cities, and moving more towards the smaller. But overall, real estate's good. Housing supply is low. People need a place to live, and the prices keep going up with all this craziness. And this is the way I look at it. Yeah, I think crypto and all this stuff will be way more. If you put all your money in, you're probably going to do better. But to me, I don't need that much money. I just want to live happy life with real estate, consistent returns, and not pay too much taxes due to the tax benefits.
And Lane, to supplement this lack of housing supply and that giant drop, that previous slide that you had regarding the price of lumber going up, point being that if the supply of housing is low and the cost to build is just going up and up, that just tells you there's not going to be a quick and easy solution where we're going to have a housing supply bump up in a snap. With the cost to build these houses going up, it's going to obviously provide, I guess, in terms of barriers to build these houses timely. And so with that said, we'll have a supply and demand issue for a while.
Yeah, it takes even the most nimble of operators a year to get something up. For most operations, institutional builders, it's going to take them 3 years. Even if things open up now, you're looking for a 2-3 year leg to more inventory coming on board. So it's just not built overnight.
Yeah. And in the state of Hawaii too, we have other issues too, in terms of we have permitting issues and a backlog.
How long did it take to build the damn Koa Ridge, right? That's like a decade or two. Goodness.
It was over 20 years in the making, because they also had issues with environmental groups. I think Sierra Club were fighting building that, because that was all farmland, agriculture. That was ag land. So besides, there's so many different barriers, right?
I've asked a bunch of construction engineers, try to get them to like, hey, let's go build stuff in Hawaii. And even the people in the industry are like, no way, man. Just do the mainland stuff. There's no like red tape and all this nonsense you have to, which is so sad.
And that's the challenge that Hawaii's had in terms of trying to bring business and industry here, right? We tried to do the high tech thing and offer all kinds of tax incentives. We tried to bring the movies and the movie industry here, which helped, but still the biggest challenge we have is how do we get off of the tourism industry. So next behind that is military. I mean, we talked about the PCSing and stuff like that. So yeah, Hawaii has some big challenges, and so that inventory shortage is going to be a long time waiting. So that's why even for me, it's not hard to talk to home buyers in terms of, I think our situation is a lot different compared to the rest of the 48 contiguous states. One of the few times we should take advantage of being out here on a bunch of rocks versus attached to the mainland.
Yeah, Hawaii's a great place to live if you got money. But honestly, I don't know how people make it here.
The cost of paradise.
Yeah. But things are looking up. John Burns came up with this chart here tracking the affordability, or kind of tracks the pricing. So they're predicting a good 2021, 22, 23 for prices to go up, is what this basically is saying. Still, their projections aren't getting anywhere near where it was in 2007, 2006. But people think things are expensive. They get more, right? This one is saying it's getting more. But the curveball here is, again, what's going to happen with foreclosures coming through. But that's the end here. If you guys would like to join our mastermind to get access to other pure passive investors, go to SimplePassiveCashflow.com/journey. We put a pause here in the incubator. We'll be a little bit busy here in my life for the next, rest of the year. So we stopped doing the incubator, which was supposed to help younger guys get started with their own remote rental properties, investing outside of the state for cash flow, get started. But yeah, if you guys like this, subscribe to our YouTube channel. What else do we got? The podcast, the website, raloho.com. Anything I want to plug this month?
Oh, with this new platform, we're trying to get out to as many different venues as possible. So hopefully we'll be on LinkedIn soon. And like you said, the YouTube, various Facebook channels.
All right. We'll see you guys next time.
Hey,
Aloha.
Aloha.
A free real estate investing group. Check out reialoha.com.